Hello, everyone. This is your lecture for week 2 of Mission Meets Profit and Building a Social Enterprise. For this lecture, we'll be looking at a number of registration options, also which are known as incorporation options. And one of the things that you'll notice is I included a number of business structures in here with just some highlights over what they look like and what they imply. Most of those are not social enterprise structures, but there are really so many different ways to structure a social enterprise that I wanted to do a brief examination of what those structures look like, just so you know what that gamut in the US offers in terms of structuring an entity. For the learning objectives for this week, we will be looking at a high-level overview of the incorporation and the registration structures in the US, an assessment of the structural options for social enterprises, looking at some of the key certification bodies in the social enterprise sector, and then jumping into 4 different case studies of social enterprises that have very different structures. One caveat, Spark Ventures, as some of you may know, that is actually an organization that I used to work for almost 5 years. So I have a number of insights that I've included in this case study that are a lot more in depth than the other organizations, just because I have been a part of the structuring of a lot of the enterprise components and can speak to some of the challenges and opportunities that we've learned in that process. And lastly, after we look at the case studies, we'll do some takeaways of this week's lecture. Jumping to slide 3 and the incorporation structures in the US. The one thing to look at and to consider is that there's a lot of different ways to structure an enterprise in the United States, as well as anywhere else in the world. The reason why we're focusing on the US is because a lot of us, for the most part in the class, are based in the US and may likely at some point structure a US-based enterprise, even though its functions and operations may be abroad. The focus of this particular lecture and my personal expertise is in the core US structures, as well as what they look like, in terms of operations abroad. When looking at the structures that are available in the US, these are some of the key considerations that we should be thinking about. The goals and objectives of the enterprise, the ownership and who we're considering being a part of our entity. Is it ourselves? Is it our families? Are we thinking of potentially growing this enterprise beyond an immediate source of funding and potentially partnership opportunities? So that's a really important consideration. What does the liability look like in terms of how will this new enterprise affect your personal life, your assets, financial and otherwise, which there's a lot of protections that are built into business and corporation structures. Taxation, taxing is probably, that is when you do your business case and your financial model, whether it's for, a business, a nonprofit, taxation is a significant part of your value proposition, especially if you choose to go with a for-profit model. And in looking at the tax structure, whether it's in the US or abroad, that may look very different and may have a significantly higher percentage when you're in a different country. That may impact your bottom line and what your financial goals are, and as such should be a very significant piece of the pie of the considerations you look at when conceptualizing your enterprise. Obviously, funding and profit distribution, or lack thereof, are also really big components. Profit distribution is tied to ownership, and then funding, depending on how you incorporate, how you register your entity, you will have options for different types of funding streams. Some of them will include both philanthropic and private. Others, especially in the business sector, will be limited in terms of the philanthropic opportunities. So it's good to know, what kind of capital you will be going after, and which things you are okay limiting to your structure and how you will pursue fundraising and capitalizing your entity. Jumping to slide 4, the main considerations. So I took these considerations, which are they're high level and intuitive to most, but to those that have no formal experience in terms of structuring enterprises beyond maybe working or volunteering for one. These are some of the key factors that really need to be considered when you're structuring an enterprise. Some of them are separate, but essentially all of these are tied very much together. When you choose one structure over another, whether it's ownership or how you register, that will have significant implications on your taxes, on how those taxes reach you, whether they stay at a company level or if they go down to your own personal income taxes, which is called basically is a pass-through model, and also the funding implications. What does funding look like depending on how you incorporate? Jumping to slide number 5, and for the next few slides, we'll be looking at just a very high-level overview of the most common registration structures in the United States and what they're structured like. Since this isn't technically a finance course, I won't be getting into a lot of detail in these. I think this will serve well as an overview of what the options look like. And obviously, if any one of these interests you in more depth, because you can certainly structure a social enterprise in a lot of different ways, you can pursue, looking at some of these in more depth as opposed to others. So looking at the first one on slide number 5, we have the sole proprietorship, which you'll have a lot of your common small mom and pop type shops, operations that are really primarily single, one person type entities. That entity is typically owned and operated by just one individual. This is the easiest and fastest and certainly the cheapest structure to set up in the States. The big issue here is when you're a sole proprietor, you tend to want to engage in business that you know very, very well, primarily from a risk perspective, but also, looking at funding and other limitations that you might have. From a liability perspective, a sole proprietorship can be quite risky because you're personally liable for any debts or losses. So if your entity is sued and you owe funding, which can turn to be a significant loss, you can be personally liable and sued on a personal level as opposed to a company level, and you may lose assets, such as your home or other things. If you have a business transaction that goes awry. Again, that's a fairly aggressive, worst case scenario, but the liability component is fairly, fairly important as a consideration. And so that is worth, noting in this type of setup. Taxation, you have your personal tax only as an owner. There are no separate business taxes to pay. Funding, so this is a sole proprietorship, so funding here is fairly limited. Most folks use personal funds or funds that they'll borrow from friends or family. You might, this may not be an entity that achieves any significant scale. It's possible to get loans, commercial loans for a sole proprietorship, but it's fairly difficult, and you are unable to get investors or have an IPO, which is a public sale of stock within a sole proprietorship model. So this is fairly limiting. It's probably not an optimal model for a social enterprise, but you are certainly welcome to explore that, if that might be something that you think might be of interest in a prospective model. Profit distribution, obviously the owner here retains all the profits as well as any liabilities, less any loan obligations or any other obligations. But this is the most straightforward and fastest entity to set up is a sole proprietorship. Moving on to slide number 6, we have the general partnership. The ownership model of this particular structure is a business wherein 2 or more people share decisions, assets, profits, and liabilities. This particular structure needs at least one general partner. However, all partners can be general partners in this type of arrangement. Basically, the difference between a general partner and a limited partner is that a GP takes full responsibility for managing the business and is subject to personal liability. However, if you have just one general partner and others are not general partners, then any other partner would have less liability than the general partner. So the general partner, although has a lot more control over the decisions of the business, the direction of the entity, this person is subject to personal liability. In terms of taxation, there are both personal taxes, so this is a pass-through entity, as well as self-employment taxes, which are primarily for benefits such as Medicaid and other general benefits that you would associate with healthcare and any legal requirements by the state. Funding in the general partnership. So this one, you can secure significant private capital within a general partnership, since you can have more than one person, and each partner will be an investor. And the profit distribution is, as is commonly done, is tied to the percentage interest in the business. So if you have a general partner that invests 50% of the capital, that profit distribution, will be linked to how much they contribute. And this is a fairly simple structure. Again, however, there are some liability and tax considerations to keep in mind when considering this type of structure. Looking at slide number 7, we have a limited partnership. You'll notice a little asterisk on the bottom, which also includes a limited liability partnership. Those are two different structures, and they're similar, yet they're fairly similar yet distinct enough where I wanted to make sure that there's a third opportunity here. I didn't want to spend too much time on it because this probably won't be a consideration for a social enterprise model, but I did want to include that so that you're aware that these two different types exist. In a limited partnership, you have an ownership structure where you have at least one general partner, and all others become, in that case, limited partners. Similarly to the prior structure, the GP assumes unlimited liability and manages the business day to day, while a limited partner has a passive interest and the liability is limited to the size of the investment. There's also a taxation difference. So a general partner who has more control pays self-employment and personal taxes, while limited partners pay only personal taxes. Funding and profit distribution are similar as in the general partnership, where you can have very significant private capital with each investor bringing their own funds, and profit distribution is usually proportionate to the interest of each partner. There can be some differences in terms of you can be a general partner and invest less, and you can have a limited partner that invests more. So there's different configurations, and just because you have a general partner doesn't mean that that partner actually pulls in the most amount of money. That typically tends to happen, but not necessarily. And so that you just, for your own knowledge, note that there may be different configurations in this type of arrangement, and the difference between a limited partnership versus a limited liability partnership, which is a third variant. That is a structure where all partners of a partnership are limited partners, and each one is protected from actions of other partners, thereby having limited liability in terms of any lawsuits, and so on and so forth. Looking at slide number 8, we have the LLC, which is the limited liability company. So the LLC model, it's a very common structure. You might actually consider this as a potential social enterprise just because of the flexibility that it gives in revenue generation, specifically when it comes to taking on additional funding. Now, an LLC is interesting because it's a bit of a hybrid between a general partnership and a corporation. For the purpose of this class, I'm not going to go into the nuance of the benefits and the tax implications, because they're very, very detailed. And I think if you gravitate towards any one of these registrations, then I would encourage you to do more research into some of the tax implications. But as a high-level overview of the LLC, an LLC has one or more owners, which are typically called either members or managers. There is no personal liability in an LLC, and taxation basically is although LLC can choose its own taxation structure, which is there's one of two really. Typically, what happens in an LLC is a pass-through taxation, which means the business itself is not taxed on a business level on the business activities, but rather the individual owner or manager will have taxes reported on their personal tax income statement when it comes to your tax liabilities. So this is, again, one of those things that does a pass-through assessment as opposed to taxing, keeping the taxing at a business level. There's also self-employment tax contributions towards Social Security and Medicaid. However, what needs to be kept in mind is that depending on the goals of the LLC has a flexibility within its structure in that it can choose to be structured or taxed as a default LLC, and can also choose to be taxed like a corporation, which we'll talk about in a little bit. Funding is typically personal funding or also conventional loans, but for an LLC, if your ultimate goal is significant growth and getting larger amounts of capital, typically investors, especially private investors, are a lot less likely to invest in an LLC because of the complexity of the LLC operating agreement as well as the tax implications. So there's less funding options for an LLC available than for a corporation. However, there is more, there is some flexibility in terms of the taxing structure, which is important to some folks. And that is definitely a consideration for an accountant. An accountant will be the best person to advise, or a tax attorney, on what the tax structure which one will be best, a corporation or an LLC, if you choose to incorporate as a for-profit. Profits are distributed as an allocation to each LLC member, again similarly to the other structures, according to their percent interest of how much they invested in the business. Jumping to slide number 9, we have a little bit of an overview of a corporation. A corporation is a business that is registered by a state and operates apart from its owners. It issues shares of stock, and that means basically doing an IPO, so initial public offering, and lives on after owners sell interest or pass away. So a corporation really is it's a very distinct entity from an LLC in that it's a for-profit, but it has, in one way to think about it, it has a life of its own, and so there is. It has a different taxation structure. It's definitely a different level of funding and of operations than typically what you will find in an LLC, which tend to be smaller than corporations. There are different types of corporations. There's a C corporation, an S corporation, and a B corporation. Nonprofits are also considered corporations. They're called nonprofit corporations. I separated them on purpose just because we'll be focusing on nonprofits more than other corporations. I'll be focusing rather on B corporations and nonprofits rather than C or S corporations. And so just in the interest of giving you a little bit of an overview of how these corporations differ, the next slide gives you a bit of a matrix that shows you how they're similar and how they're different. Looking at slide number 10, we have a matrix that shows you the most common corporation structures. I won't be going through all of this because you can take a look at this on your own time and and dive into some of these nuances. The big difference here, we have an LLC, as I mentioned before. We have it's basically a hybrid between a general partnership and a corporation. Most of these, as you can tell from a liability perspective, there is no personal liability as opposed to a sole proprietorship, which is a big difference. But keep in mind that just because there is no personal liability, and in a question of a lawsuit, for instance, if there's a lawsuit, there can be, if there's negligence found, for instance, whether it's by a board of directors, or if investors choose to pursue a lawsuit, that lawsuit will be against a company and potentially, some individual investors. That is definitely a possibility. However, typically those lawsuits, despite being fairly common in the United States, they don't cross the threshold of capturing personal assets of those involved in those companies. So that's what really the no personal liability implication means. It doesn't mean, however, that you can't be sued. You can definitely be sued whether you have a B corporation or an LLC. The big difference here, we'll look at a B corporation separately, but if you're looking at the difference between a C and an S corporation, the C corporation is really the default structure. It's, you have one or more member. The big thing that you'll see in a C corporation is what's called double taxation, which if your business has profits from your operations, you will be taxed on those profits. And when a company issues dividends, or shares of stock, individual share or dividend holders will also be taxed on those distributions. So the shareholder, you will have that you will be taxed, beyond the company itself. Now, this sounds a little unfair, especially to those who are not familiar with this type of taxation. There's a lot of different ways to go around this, or not around, rather. There's still, there's double taxation, whether regardless of what you call it. However, there's different ways to retain profit within the company itself, and different ways to structure where the profit goes to minimize some of those tax requirements. That would require an assessment with an accountant, as well as an attorney. But the big thing between an LLC and a corporation, especially the default corporation, is this element of double taxation on business profits and dividends paid out to investors. The S corporation is a little bit different. It's more limited. It can only have up to 100 people, and all of them must be U.S. citizens, as opposed to a C corporation, which doesn't have that limitation. It has personal taxes, so it's similar to an LLC. It avoids the double taxation whammy. And however, there are some limitations in terms of what kind of stock can be issued. Again, for the purpose of this course, we're not going to go down into that level of financial detail. I encourage you to ask questions if you have any on these topics. Though I'm not sure that you will be thinking about S corporations unless you then certify them as a B corporation as a prospective enterprise. So this is just for your background knowledge. And looking at the funding options, again, we discussed them a little bit under the LLC slide and the former slides, but you have you have loans, conventional and otherwise, and personal loans. You have venture capital, angel investors. Corporations can have a public offering and can issue stock. That is the big difference between them and an LLC. So if you're thinking about significant operations and you require large investment of capital, especially for infrastructure or major assets, then you will likely pursue a corporation of some sort. A B corporation, again, there are some differences in terms of taxation from an S corporation, but a B corporation, which we'll talk about shortly, is very similar in terms of a C corporation, your default corporation structure, in terms of taxation. It's very much the same. There are no special perks in that space. Turning to a B corporation. Now, B corporation, as you have seen in some of your readings, are a fairly new phenomenon. They've been around for about a decade or so, maybe just a little bit longer. So they are fairly, in terms of the broader registration context, they are newish. However, they're not as new as to only be U.S. entities. The B Corp movement has expanded beyond the U.S. and it's now present in a lot of countries. And I focused, the reading that I shared with you was on Australia, and how the B Corp movement in Australia has taken off. But there's also a lot of other case studies that are showing how B Corps are being incorporated in very different contexts, which is very exciting because this is becoming a global movement that really looks at the bottom line and beyond, and incorporates social and environmental well-being into a corporation that can grow to be of significant size. In terms of the structure, looking at a B Corp, one or more owner, typically, this will be a fairly significant entity. It can be as little as a small business with a few personnel members, as large as Patagonia, which is a very large company. Liability, again, it's similar to an S corporation, a C corporation rather, where there is no personal liability. The great thing about a B corporation, which gives you access to a lot of different capital, but it also basically dictates that you are driven by a mission and whether it's a social or environmental cause, is that B Corp directors on the board of directors, as well as shareholders, acknowledge and make it part of the business structure that the primary duty of that corporation is the mission of the organization, whether it's environmental, social, or anything else, and the fiduciary duty to maximize shareholder value and profit is a second consideration. So typically in a normal corporation, your owners, your investors can absolutely sue you if they figure out that you've either been omitting information from their knowledge, not disclosing factual information about your customers or your business transactions, but also if based on that, if the company is not maximizing the profit of the company, it can very commonly be sued, and that happens on a fairly regular basis. So B Corporation, there's an insulation from that, where the primary objective of the board of directors is to maximize the common good of the organization's mission. Taxation, it's the same thing as a corporate tax structure, so it's a C corporation. Funding, although it's the funding opportunities are fairly similar to other corporations. You have investors and you have debt, and you can take on quite a lot of different type of financial instruments. There is a lot of philanthropically focused funds and angel investors and impact funds that are looking to make investments with a lens for social and environmental good. So this is a really a great growing space. There is some nervousness in B Corps declaring IPOs. There's certainly a number of them that have, but there is but there's, I think, part of the questions that are still in the marketplace is what happens to mergers and acquisitions, and some of the ambiguity of what a company needs to consider before being acquired by potentially a company that is not a B corporation. So there is things like that are I think making some entities hesitant in becoming a B corporation. However, this movement has grown, and it's very exciting in terms of the conjunction of social environmental goods and benefits, as well as the profit maximization motive. Profit distributions, again, same approach and expectations as a standard corporation. So you have profit that can be reinvested into the business, as well as you can have you have payouts of dividends to your investors. Moving forward to slide number 12, we have the L3C, which is the low profit limited liability company. Now, I had you read a few articles on the L3C for this week, and mostly what I wanted you to get from those articles is to hear some of the initial excitement as well as skepticisms about the L3C model. A lot of that literature came out 6 or 7 years ago, maybe even a bit more. And that is because that's when the energy was really growing in the L3C movement. And the reason for that is because the L3C was really intended to be a hybrid between the nonprofit and the for-profit, and maximize a social or charitable mission while also being able to take on private investors and later distribute those profits to the investors. And so that was something that was really focused on the sustainability of this model and looking at how to take a social mission and create new avenues for funding for it without necessarily being reliant on donations and grants, which an L3C as a for-profit company cannot accept. Another really big aspect about the L3C was that it was created to be a really great vehicle for what are called PRIs. PRI is a program-related investment, and it's typically what you'll find is that you'll find PRIs closely tied to foundations. Why is that? Well, in order to keep its tax-exempt status, a foundation has to, by law, direct at least 5% of its assets to charitable purposes. You would assume that the foundations already do that, but in order for them to actually do it, there is this requirement from the IRS. And so one way for a foundation to do that is to issue grants, which typically you'll find most organizations or foundations do. But also another option is to issue a PRI, which is it's a loan, it's a guarantee, or it's an equity. So it's a revenue generating mechanism for a foundation, but it has to be again tied to that foundation's mission. In order to invest in a for-profit business or issue a loan, guarantee, or equity, a foundation would need to get permission from the IRS, which is a fairly intensive, time-consuming process. And so you would not find many foundations actually engaging in that just because of how cumbersome it was. So the L3C was really a model that was structured to create that opportunity and to divest some of those PRIs from going into grants, or not grants, but towards nonprofits, and really to create a new class of investors and investment opportunities within a socially mission-oriented movement, but with still some market or even below market return expectation. And so the L3C was created. So, some of the problems, though, because you probably don't hear about it very much, definitely not as much as a B corporation, but the L3C still exists in several states. You might check in your own state to see if it's in yours. A lot of them are on the East Coast. L3Cs, again, the primary duty of an L3C, it has to be an environmental goal. The second one is secondary duty is getting generating profit. However, there's a caveat there that's implied that this profit is low. Part of the problem is that what low means hasn't really ever been fully defined, and there was a lot of criticism in that any company could potentially structure an L3C and really take advantage of these foundation opportunities that were really not intended for private businesses as much as they were for charitable purposes. So you have the L3C model that has been a really interesting. It had a really interesting trajectory in developing in the last 10 years. And then it kind of tapered off and it stopped. And so, each state has had a different experience with it. I think the ambiguity around it and some of the transparency that wasn't inherently applied to L3Cs, much as you would find with 501c3s, which are very transparent and they have to be, that turned some people off. And these grand visions and ideas of what this L3C movement would look like didn't really grow as fast as they were anticipated. Turning to slide 13, we have our nonprofit 501c3 model. What should be noted is that the 501, there's a 501c designation to other, there isn't just the one 501c3, there's also 501c4, which is intended more for lobbying and for political activities. But for the purpose of this, this lecture, we'll be looking at the 501c3. For your knowledge, you could look at 501c4, which is more politically and lobby oriented, which is a little bit outside the scope of the social enterprise component of this and focus of this class. But I did want to let you know that there are different nonprofit types depending on the activity, but the main nonprofit one that most focal point or most attention is around is the 501c3, which is your standard classic nonprofit corporation designation. So the nonprofit, the ownership of nonprofit, it's a public good entity. It cannot have any owners or shareholders. It can have a CEO or a funder, but this is a public good. The nature of a 501c3 is that it belongs to society and it benefits a greater purpose. There is significant IRS oversight of nonprofits, which have to file annual reports. They have to make what's called the 990 form available to the public to show exactly how the organization uses its funds. There's a lot of scrutiny and transparency requirements for nonprofits, which for the most part is very good. However, it adds a certain level of bureaucracy and visibility that businesses don't have to contend with. Liability, again, there is no personal liability for funders and for staff of nonprofits. That being said, a nonprofit can be sued if it's misdirecting or misusing funds. However, typically, again, the nature of those types of lawsuits are more at an organizational level as opposed to the nonprofit one. What you may, if you consider establishing a 501c3, which is very common, both for the pure charitable purposes, but also for social enterprises, for some of the more risky nonprofits, there are different insurance options for boards of directors that some boards choose to take on to further completely evade, not evade, it's a strong word, but really to mind any liability that can be assumed with potentially taking the nonprofit in a direction that may be questionable. Again, that's kind of a sidebar, but typically there is also no personal liability in nonprofit corporation. Taxation. So taxation is really key here. Nonprofits are tax exempt. What's worth noting is that a 501c3 can lose their status, and it's very difficult to get it back if your organization engages in activities that are not related to its mission. This also becomes particularly relevant if your nonprofit has any for-profit subsidiaries or revenue-generating activities that are not directly tied to its mission. The IRS can conduct an audit, and if it's found that those activities that are intended to sustain the organization are not directly related to the mission, the nonprofit can lose its tax-exempt status and go out of business. So that's fairly important to note. Funding. So funding is really a key point of conversation here. So the nonprofit has really evolved in terms of how it sustains itself, and you've got a really broad spectrum of nonprofits. Most of them are heavily donation and grant oriented, have fundraising plans, galas, events, and all sorts of fundraising structures. That's the common conception of nonprofits. But nonprofits can also have earned income, to various degrees. It can be almost entirely earned income oriented, where you charge for your services and your products. Or it can be a combination of earned income, donations and grants, and other types of structures. Nonprofits can also receive funding from endowments. They can invest and receive stock options. They can apply for and receive loans. Typically, you'd have to have some level of collateral and assets to get those loans. So they're not necessarily very easy to get, but for larger entities, that might be an option. They can earn interest on loans issued, and you may, whether it's little loans, microfinance, or significant loans. And they can also own for-profit subsidiaries, such as LLCs. So funding is really, there's a lot of creativity here and a lot of opportunities for a nonprofit. And again, it really depends on its mission and orientation. Some charities and nonprofits, the nature of the work is really prohibitive to revenue generation, such as hurricane relief or really significant humanitarian actions and missions. So really the opportunity for funding and where it comes from is heavily tied to the nature of the mission of the nonprofit. Profit distribution, this is widely known but worth repeating, is that any profit that is made by the organization, and a nonprofit can certainly make profit. That's a common misconception that it can't. That profit must be reinvested into the organization to further its mission and goals. It certainly can save some money and put it into savings, but any kind of profit that the organization makes must be reinvested into its programmatic and social goals. Jumping to slide 14, we have some certification bodies. We could probably do an entire lecture just on certification bodies. So this is just a high-level snapshot of some of the main ones that you'll see. It's not an exhaustive list, but these are ones that you'll probably come up as the most active ones in your research. So B-Lab certification, and this is, sometimes there's confusion in terms of what that means and what certification means versus what it means to be a B Corporation. So B-Lab certification, this is a third-party standard. It's managed by B-Lab, which is a nonprofit organization. And what this organization did is it developed an assessment that's fairly aggressive and has a lot of in-depth questions about governance, social, environmental, and other questions pertaining to how the entity does its business. And it's basically, it provides, if an entity chooses to become certified, and by entity I mean business, you can take this certification, get a score to look at how your operations compare to what is defined as strong in those different subject matter areas. So employments and benefits, wages, just a lot of different categories. You can see what those categories are and what type of questions are on that assessment on the B Lab website. But basically, it's a certification that a company can apply for, and it has to pay for it. It's not free, but it's independent of the actual company. So you can be, you can start as a regular corporation and then get a B Lab certification without necessarily becoming a B corporation. Now, a B corporation is different. It's a bit more involved than a B certification because it changes. What it means is that you incorporate your business as a B corporation, and you change really the soul and ethos of what your business does. And you do that within your charter and your bylaws, which are really the guiding documents for your business. And within a B corporation, you basically say you choose a social, environmental, or other mission, and that is the primary mission that the board of directors is expected to protect and fight for, with the fiduciary, so profit maximization motive, being behind that. It's an important motive, but it's the primary motive. So there is a difference between a certification, which can be adapted down the line, and a company can grow first its operations and then improve them and make certain changes in order to be a B Lab certified company and show and display proudly its score, which again, there's different rubrics in what these scores mean. But typically you'll have an annual audit as a B Lab certified company, with a link to your score and how you fall within that assessment. So it is a little bit different than an actual B corporation. Then moving forwards to the GIRS, the Global Impact Investing Rating System. Now, this is a rating system that's slightly different. It's also powered by the nonprofit B Lab. It's an assessment tool, but it's primarily for impact investments. So whether those are funds or other types of impact investment-oriented entities, it's basically a rating system that's also voluntary, that uses categories such as governance, workers, community, environment, and other indicators in order to measure the enterprise's impact. This one is primarily focused on an impact investing lens. And again, you can go online and check out what the difference is between GIRS, but it's really a platform to compare different impact investments and what is promised in terms of return, but also what the indicators of success are in the social and environmental and other realms. Fair trade, now this is a slightly different perspective on certification, and you're probably familiar with fair trade. It's an international movement, and there's at least, I think, 3 different entities that have slightly different profiles. For instance, Fair Trade International and Fair Trade USA are 2 different organizations. Fair Trade, they used to be together, but they broke up, and they are now a little bit separate. They had some existential differences in terms of who can be certified as fair trade, which I won't get into in this lecture, but you can easily look it up in terms of what cost Fair Trade USA to break off from Fair Trade International. It's a really interesting story, but basically it's a payment of premiums on products sold by farmers who certify their production according to multi-pronged environmental, social, and other standards. Those standards are part of audits, which have to be complied with on an annual basis. Now, those audits, which are part of that certification, they do need to be paid for by the farmers, with the caveat that they increase farmers' income by having those certifications. However, the fair trade movement, there's been a lot of different thoughts on this movement, and it has shown great value and great promise, but it's also not immune from criticisms. One of the major criticisms within the fair trade movement is that some of the small farmers that would like to be certified can't actually afford their certification and the stringent rules on what they need to do in order to become fair trade certified. And if they do seek that certifications, they can actually be put out of business because of how low their profit margins are. So this is, again, it's definitely a known international certification. What it means is slightly different, and again, different countries also have their own fair trade designations, similarly to organic certifications, which is a little bit beyond the scope of of this class, but it's worth seeing that those products which have that designation do fetch higher prices, and typically those products provide a higher margin for the farmers that sell products using their certification. Now, the BBB accreditation, which it's the BBB movement has been around for over 100 years, and a lot of, I think, millennials don't realize that, because it's become less relevant for the current millennial generation. Back in the day, I used to work as an investigator of consumer fraud for the Better Business Bureau. That was before a lot of the things that they're doing right now. So I do have some insight into what the BB accreditation means, and it's been around for decades. So it's quite an established entity. There's over 100 different branches all over the country and in Canada. And basically, what an accreditation means, it's businesses that pledge to committing to ethical consumer marketplace behavior. They agree with different standards, and those standards are defined by the Better Business Bureau. They also agree to a dispute resolution process with their customers, which is important because that means that their complaints can't go unanswered. And they also they pay membership fees, which is a big part of this relationship. They pay membership dues based on their size to nonprofit BBB chapters for the close monitoring and handling of the consumer complaints, as well as maintaining public scoring and reporting, and being able to use the BBB logos and other branding pieces in marketing and advertising. And that helps boost sales and also ensure marketplace trust. Again, the BB accreditation has been around for many years. It's changed a lot, especially when the internet era hit. I think it's a little bit less relevant to the current millennial generation, but it's definitely still an option out there for companies to pursue BBB accreditation along with potential other certifications if their model warrants that or would benefit from it. And it's worth knowing that BBB accreditation is still definitely part of the marketplace system. Jumping to slide number 15, we start looking at our case studies. These case studies are on 4 different social enterprises that have both a very domestic and very much international focus points and missions. And these are all social enterprises in very different ways. And 3 of them are 501c3s, and one of them is a private entity that has become B certified. So looking at the spectrum of opportunity, it's really interesting how an enterprise can be structured and really how it can utilize its various tools and funding opportunities in order to create and carve out its own model. So looking at Spark Ventures, which again, full disclosure, I was a part of Spark for almost 5 years. I know that model very, very well. It's 501c3. It's a nonprofit international development organization. It's incorporated and HQ'd in Illinois with programs exclusively in Zambia and Nicaragua. Spark's mission was to provide sustainable solutions, lifting children out of poverty. To give you a little bit of background about the model, so Spark initially supported or partnered with nonprofit organizations in developing countries. These 2 countries in specific were Zambia and Nicaragua. And it supported these partners that provided children's programming and nutrition, education, and healthcare. So whether it was providing school books, paying salaries for teachers, providing meal programs, clinics, those were the partners that Spark Ventures supported. And it was through primarily philanthropic donations. So it was monthly wires to our partners to support those programs. And separately, beyond the philanthropic funding of programs, Spark also raised capital. Again, this was initially primarily philanthropic capital to launch small to medium-sized businesses in those countries, with the idea that these businesses, once they're scaled enough, they would be able to employ some of the children that were supported by the programming, but also, down the line, these businesses, once they become sustainable and profitable, part of the proceeds were intended to then support the operations of Spark's nonprofit partners with the long-term vision to Spark be able to have an exit strategy, and for these social enterprises registered in those countries to take a life of their own and to support their nonprofit subsidiaries. So that was the model. The original investments in in those two businesses. One was a poultry farm. It was a commercial of a poultry farm that could raise 21,000 chickens in a 5-week cycle and sell them to within the supply chain. The second business was in Nicaragua, which was, and it still exists, both of these actually do, a very significant 180-acre cocoa and multi-crop farm that had different revenue-generating crops, as well as some agro-tourism as part of that model. And so, you can visit the website to really get a better idea of how these enterprises look and what they provided, both to the local communities as well as what the long-term vision was. The key problem within Spark, and there's a lot of challenges. One, it was the organization was quite small and relied heavily on a lot of constant fundraising to both support charitable programs of our nonprofit partners, as well as to raise the capital for business investments, which were not microfinance. They were significant, and to give you a sense of scale, the poultry farm had an almost over a course of 10 years, there was a total of almost $1 million invested in it, and then the for-profit farm in Nicaragua had almost $500,000 invested in the first 2 years. So these were significant investments rather. And as businesses tend to develop, they need cash for both for operations as well as for capital expenditures. And to have a small organization focus on getting funds for both significant programmatic support that was charitable, as well as business investments, as well as finding the right managers for those businesses. Although that took place for many years, it became very, very difficult to do, and the actual profit margin was significantly smaller than initial projections showed. And so the financial contributions from those social enterprises in Zambia and Nicaragua were very modest, and they could support certain things for our nonprofit partners, but definitely not a significant amount of ongoing operational needs, which warranted a pivot in that model a couple of times. The second time was, and this was prior to the second investment in Nicaragua, the Spark decided to take on an impact investor with us, so we could raise philanthropic capital and then also have a private investor that would have profit return expectations that were below market and long term, so we can launch the second business sooner and faster and have a better opportunity for larger returns. That was also challenging because the farm itself, agriculture, is very risky, and the numbers also were less. The initial return was much smaller, and some of the primary income generation comes from cocoa, which is a long-term crop, which is still growing, and that business won't reach maturity for quite some time. So in order, there was this constant tension for Spark to not only support its philanthropic partners, but also to create a way to subsidize its own operations. So there was some irony there that Spark was trying to support its partners in the field and make them sustainable, but actually Spark Ventures as a 501c3 was not sustainable in its own operations. So what happened recently, actually this year, so 10 years in, Spark changed its model a little bit, and actually significantly, because it took one of its revenue generating models, and that is hosting impact trips, so taking folks to Zambia and to Nicaragua on these very significant trips that highlight the model and the process and meet the partners and do some volunteer activities, but also learn about development in the process. They took that model and they created an LLC, a for-profit LLC, which is a subsidiary of Spark now, for the purpose of basically running those trips as its own model to amplify its revenues and then support the philanthropic partners via the LLC, as well as through the nonprofit, which is the 501c3 Spark Ventures. So that change is actually taking place right now, and it's this interesting case study going on 10 years now to take a look at to see how Spark tried to infuse the social enterprise model, within partner countries, and then currently it's trying to do that on itself, trying to help its own operations become more self-sustained and not only reliant on donations. And we'll see where it goes. It's entering a new stage, and we'll see if the LLC model will be able to help Spark and the new entity, which is called Ignite, focus more, one, on the philanthropic support for our nonprofit partners, and the second one to really raise the revenue and the profit from these very intense trips that Spark used to host under its nonprofit umbrella. The sustainability, of this model, again, it was primarily donor funded. There was an attempt at impact investing, which then moved. It went from a joint venture impact investment model to then Spark taking on a more limited role in the business, in the enterprise in Nicaragua, just because of funding implications. And currently Spark will focus, there's going to be, again, a break in a separation from the for-profit and the nonprofit activities, with Spark Ventures focusing on philanthropic fundraising for partner programs, and the new LLC focusing on revenue generation of activities that Spark used to engage in as a nonprofit. So the verdict is still out. It's been a 10 years of a 10-year experiment, and we'll see how Spark does with its sustainability goals in the future. The second case study is Root Capital. Root Capital is a 501c3 social investment fund. I encourage you to look through their website. They have a lot of great materials and resources and publications of their model and how it has grown. Root Capital is very, very large. It's incorporated in Massachusetts, but it has loans and programmatic activity all over the globe. The focal areas geographically has been Latin America and Africa, but that has grown, and we're talking about multi-million-dollar investments in companies that promote value chain development in rural areas. The mission of Root Capital has been to grow rural prosperity in poor, environmentally vulnerable places in Africa and Latin America by lending capital, delivering financial training, and strengthening market connections for small and growing agricultural businesses. Root Capital has been a really fascinating model because while it's a 501c3, it has a very diverse portfolio, and it balances looking at lending, and it accepts donations and grants, and that's part of its portfolio. You can see that as on its 990 form, its financial statements, but it also, creates value and makes, generates income on the loans that it issues. And these are, these loans are not microfinance loans, that they're fairly significant, anywhere from $50,000 to multi-million-dollar investments. And so there's definitely a revenue generation that's very, very significant, that's generated a lot of capital to balance the philanthropic donations and the grants with Root Capital's income generating activities. Root Capital also boasts a 97% repayment rate on the loans that it has, which is very impressive, and part of that is because they provide a lot of financial training and some definitely more flexible terms than conventional banks and financial corporations that really don't like to work with very high risk companies, such as a lot of the agricultural businesses in countries in vulnerable places like Africa and Latin America. And so here you see a great example of significant financial acumen and a strong mix of revenue generation plus philanthropic donations, as well as a fund. They have Root Impact has its own fund that is separate from its loan portfolio, where you can actually invest into that fund and get returns. And that is a separate piece of their model that I encourage you to look at. This is a very financially sophisticated model. It's been around for over 10 years, and they have grown significantly. Again, their model in terms of sustainability is very well capitalized with key tools from loans, serving sectors that have been locked out of commercial lending and generating returns at significant scale, or at least scale that's significant enough to manage operations and staff all over the world. So this is a great example of how a 501c3 can be a very, very successful social enterprise. Looking at De La Gente, which is our next case study. De La Gente is a 501c3 nonprofit social enterprise that is incorporated in Massachusetts. However, all of its operations are based in Guatemala. The mission of De La Gente is working with smallholder coffee farmers and cooperatives in Guatemala to create economic opportunities that improve the quality of life for their families and communities. Now, if you look at the De La Gente website, it will strike you as primarily a social enterprise for profit, but it is in fact a nonprofit. What De La Gente does on a fairly small annual budget, the annual budget is under $1 million, which is really quite small. I know they're growing, but I just wanted to show you a difference between how a social enterprise nonprofit, how large it can be, such as Root Capital, and how small and nimble it can be, such as De La Gente. So De La Gente, primarily what they do is they sell the coffee that they help the co-ops with. So they do a lot of financial literacy training, production training, or organizing and selling, but also branding and marketing of the coffee, which is a very significant factor. But coffee is a commodity, so as you know, those types of commodity prices tend to fluctuate. So coffee can be very profitable, but it can also be unprofitable, and coffee has taken a major hit in Central America particularly, but also all over the world in different timelines, especially when La Roya hit. La Roya was it was a coffee rust that impacted coffee plantations all over the Central America and also South America. And so De La Gente works with farmers to enhance training and production and organization, and then of these co-ops, and then it finds markets and new buyers for their coffees. So the story of the farmers and supporting communities is a big part of the branding and the marketing strategy of De La Gente. And this is what drives up the value of that coffee, which it ships out and sells. I believe currently it's only North America, but they are looking to expand their markets to Europe. De La Gente also, although it's a social enterprise, very much earned income driven, they also have a diverse portfolio of including community tourism that they charge for. So those are services they offer to visitors in Guatemala, but also to students and other organized groups. They also sell merchandise and other smaller pieces, but beyond their earned revenue, earned income, they also accept donations for some of the work that they do. And I know that they are actively trying to increase the size of their philanthropic portfolio that's grant and donation based, in order to balance out the revenue that they can provide to the farmers, as well as the sustainability and the growth of the operation itself. So this is a really interesting model in terms of the sustainability snapshot. Again, the bulk of De La Gente's revenue is driven by coffee sales, making it a good example of what a self-sustaining nonprofit looks like that is not donor dependent. However, again, it's worth mentioning that their budget is under $1 million, with great prospects to scale, but a lot of these but there are some limitations in terms of what scaling can mean. So I wanted to show you a smaller profile next to a larger one, which we just looked at in Root Capital. Our last case study is City First Bank, which is a really interesting social enterprise. It doesn't identify as such, but it actually is, because what it is, it's a mission-oriented for-profit commercial bank which reinvests its profit in community development. City First Bank is based in Washington, D.C., and all of its activities are targeted towards this particular geographical area and its community development, looking at low to moderate income communities and businesses that have been typically and historically excluded from commercial banking for whatever reason, whether it was institutional racism or other factors. City First Bank really focuses on reinvesting its profits in the community. It's a very hyper local enterprise. Really interestingly, and I was at a conversation that they were featured at a few months ago, and City First Bank at that point was going through the process of becoming a B Corporation. So it was certified as a B Corp in April 2017, so just a few months ago. If you go on their website, they have a press release with a link to their score. So when you go to their score, you will see their profile and their assessments. You can see how they score, both as an average in the industry, as well as just their own personal score and how that compares to other similar entities. It's really interesting because they really are very much a unique entity, not only in DC but as a bank that I overall. And there's definitely community-based financial organizations and entities that help with financial inclusion. But as a bank, this particular entity, City First, is really one of a kind in the Washington, D.C. area. The mission is, City First is an impact-driven commercial community development finance provider comprised of a nationally chartered commercial bank. Let's see here. It has several nonprofits. It's related by common board members and management, operating as a unified organization with a focused vision, strategy, and management system towards servicing low to moderate income communities, of which there are quite a bit in DC, primarily in the Southwest and Northeast district. So the model itself, again, it's a for-profit commercial lender that focuses on commercial loans to for-profits and nonprofits, as well as individuals that have business purposes. Looking at its sustainability snapshot, this is a really interesting example. Another, similarly to Root Capital, it has a very much financial viability as part of its mission, and so it prioritizes its financial viability as an institution because its primary service is to provide loans, and so it needs to make sure that its own financial health is taken care of, so it can serve more and more communities and ensure its own survival. The financial terms and conditions that the loans are operated under, as well as the other financial tools that Citibank or First City operates and offers, are a little bit different than commercial banks. You can take a look at what they offer on the website if that interests you. But this is really both very much a for-profit and mission-oriented organization that prioritizes both profit and its mission that's very much social at the same time. Looking at slide 19, this is a pretty dense lecture in terms of content, so I'm going to try to, not going to read the slide, you can read that on your own, but really some key takeaways for your future prospective social enterprise. What's really critical beyond anything is, depending on where you want to launch your enterprise, you need to know what that local regulatory context is like and how you can structure your enterprise. You may, if you choose to structure it in the US, you already have some information on how to register and what the incorporation options look like, as well as what some of those limitations are. Those will differ, keep in mind, in different countries. So if you have, whether you register your enterprise in a separate country entirely, or you register it in the US and then have operations elsewhere, you will have to keep in mind that there may be two different sets of regulatory context that you will need to learn about. So for instance, in the case of Spark Ventures, our operations, the nonprofit operations for Spark, were really organized under the US context and what we've been doing in the States. However, the social enterprise that we launched was a Nicaraguan entity with foreign investors. Spark was one of those investors. But we had to learn all about the local enterprise in Nicaragua as well as in Zambia, and what structures were permitted, what their taxing requirements were, what we needed to know about ownership structure and the percentages of ownership structure. So you will really have to do some due diligence research if you're planning on taking your enterprise to an international context. Registration and corporation choice will impact the kinds of funding streams that your social enterprise is eligible for. Keep in mind that having a nonprofit, although in the US, nonprofits typically enjoy a positive reputation, in different contexts they don't. In Nicaragua, for instance, there was a history in the 90s of money laundering, and nonprofits were used as money laundering vehicles for quite some time, especially during the Civil War. And so different registration and incorporation structures may carry certain stigmas with them. And so it's important that you learn, talk to other nonprofits or talk to other organizations, but more importantly to legal and tax professionals in the context where you will be doing your operations to understand the limitations of what you want to do. What is really recommended, and this is what we did, and I took part of that process in Zambia and I led it in Nicaragua, is if you're entering into a new country, whether you want to register a company or a nonprofit there or conduct some sort of operations, even if you're registered in the US, you will need to do an assessment of what are the registration options, and given your goals, what the recommended option is the one recommended for you. You'll have to look at ownership, you'll have to look at taxing. Again, tax structures vary dramatically, so you have to be really, really certain of what your bottom line will look like. So beyond the goals of what you want to do, you'll have to have a financial model. Even if you don't have real numbers, you have some mock numbers, you'll have to run them through and incorporate the appropriate tax structure, especially if you have a for-profit, that will give you an idea of your sustainability at the end of the day, which can be significant, or it can be it can actually kill your entire bottom line if your margins are very, very thin. So that's a really important consideration. So one of the things that I recommend, again, in the US, this is a little bit easier because there's so much information already available free of charge. But a lot of law firms, especially in countries that are now trying to increase their foreign investment, but just anywhere you will find law firms that will offer these types of consultations. Typically those consultations are not free, but most law firms have pro bono services that might either give you a discounted consultation or they might do it for free. When Spark Ventures was doing its joint venture with an impact investor, we went through a very large law firm that took us on as a pro bono case. So we had several attorneys that were actually working for us free of charge while doing this fairly complex structure. Which saved us probably thousands and thousands of dollars. So it's really important that you look at what you need to do, but also how you can finance it, and if there are options for a reduced cost for that activity. Separately, I very much encourage you rather, to look at other entities such as the Thomson Reuters Foundation's Trust Law Service. I provided a hyperlink in the slide. This is a service of the foundation that provides global pro bono legal advice and assistance to NGOs that are looking to expand their operations to new countries and grow their impact, and they need advice on structuring their businesses or their NGOs. So this could be a really great tool that could provide you with free legal advice if you choose to go to a country where you're unfamiliar with the context. Separately, looking at a social enterprise, again, in the US specifically, it can be really structured in a lot of different ways. As a nonprofit, as a for-profit, you can become a for-profit, and then initially as a B corporation, you can have it ingrained into the soul of your organization, or you can start as just a purely for-profit business and then add on a B certification with time. That obviously there's limitations to that, or not limitations, but drawbacks in that if you don't already have a social mission or social activities baked into your model, it's difficult to do it once you start a business that doesn't inherently and initially think about these things in the first place. So it's really important to look at how you pursue your structure, but separately, there has to be a very key and honest assessment of how you will look at your revenue generation, and if you have the personnel, the skill sets, and the capacity to diversify your revenue. Donations and soliciting donations and grants is very common. It's an ongoing activity for a lot of nonprofits, but revenue generation, especially when you charge for products and services, that's a whole different level of activity that requires you to think of the pricing of your products or services. And beyond pricing, you'll have to look at, beyond satisfying your costs and getting to your break even, what is the actual profit margin at the end of the day from your services and your products, and to what extent will it sustain your social enterprises operations, especially if you're a nonprofit. In the case of Spark Ventures, Spark tried to take on way too much, both significant philanthropic programming that had no return, and then raising capital for two medium-sized businesses. They weren't small, they weren't micro enterprises. So it really stretched too thin, and management of these enterprises also became an issue, and making sure that those management teams had the capacity the skill sets and the support, ongoing support in those countries. So there's a lot, there's a lot to be said for making sure that the people that are around the table, have what you need in order to pursue your goals, especially when it comes to revenue diversification. And lastly, while conceptualizing a social enterprise and its mission, it will be crucial to determine how you actually measure your success. What does success look like? What does that impact? What does it mean in terms of financial metrics, in terms of social and environmental ones? Are they clear? Can you easily measure them? If so, how do you do it? The more specific you can get, and the more indicators you can tease out, specific numbers and figures that you're trying to achieve, the easier it will be for you to actually evaluate your success. I'm not saying it'll be easy, but it's easier than a vague notion of improvement in the status of something. Program evaluation and metrics will be a topic for a separate lecture. But this will be really important, again, not only to defining and knowing if your organization is successful, especially if it has a social mission, but also to see if the different third-party certification bodies, such as a B certification or any of the other ones, will add any credibility or strength to your brand. You can definitely access new audiences and request a markup if you have a free trade, or I'm sorry, not free trade, fair trade designation. That's typically, there's premiums associated with these brands, as well as, a market-based signal of trust and trustworthiness, such as the Better Business Bureau and BBB branding that you might see on certain businesses. So that is, again, those are not requirements for a social enterprise, but they're definitely things that you should keep in account. What I would also lastly recommend is, looking at the B Lab assessment tools and looking at what metrics they identify as part of social, environmental, and governance standards, and how maybe you can infuse some of that into your own structure when you consider structuring your social enterprise, and what you will, and make a determination on what's important to you. It may be that you start with a few certain measurements, and as you grow your entity, you add on certain metrics, but the sooner you identify how you measure your success, the easier will be for you to measure your success and also to communicate that externally.